So if you look at the way we've been trading, the way that I have been trading and alerting, what we end up having with these corrections along the way, we have these like little corrections along the way. Like there's a correction. Let me draw it in yellow. But what we also have with these corrections are sharp bounces when stocks get oversold. So this is just the SPY, so it's a little hard to do it here, but because it's 500 stocks, right? So just watch. This is a correction. That's a correction. That's a correction. That's a corrective move. That's a corrective move. This is a big time correction, right? But one thing that we don't talk about that much, well, I do, right, is the reaction or the bounce off of the correction. The bounce off the correction, if you remember when COVID hit, they're so violent. These violent moves to the upside are hard and short-lived. And sometimes the corrections lead to sustained rally. And sometimes they don't. Sometimes they do, and it's kind of short-lived until this. But if you open up that, you will see the sharp little bounces that are corrective. Can you see them? From here, the next day, see that? But it didn't last. See this? But it didn't last. See this? But it didn't last. This seems maybe a little different. So the strategy that we've been using for a while now is that, and this is going back all the way to here. This is going back to before the, sort of the end of the year, even before that. Like really in the fall, we started this strategy, is that we did sort of longer term short positions. Remember when we would do like put flies for the monthly expirations on Microsoft just to start a long position, or Nvidia or Apple? Remember we did a little bit longer term positions we would put on the markets. Why? Because the markets were overbought and we were looking for a potential correction as the markets began to reverse to the downside, and we would have those, reversal candles and confirmation candles, right? Do you guys remember us doing this? Longer term short positions. Plus, we also did some hedging to it. So we would put, maybe SPY calls, right? Or we would trade TZA, which is the leveraged ETF of the Russell. We would do SQQQ puts for a hedge in case the markets went up, in case the markets went up, in case the markets went up, right? And we did these short term. Do you guys remember? So I'll just draw it here so it's a little easier to see. So the strategy was that we would just call it puts for now, okay? We would trade puts, but we would do it for a longer term expiration. But then the calls would be like shorter, like weekly, for the hedge, just in case we got a little bit of a bounce, right? So this is the way we were trading on some of these corrections, but because they had those sharp bounces, we wanted to make sure that we had a little bit of a hedge. And you can scroll back and look at the alerts and you'll see this is kind of what we've been doing, right? And then after let's just say we got a bounce, a little bit of a bounce, or the bounce was about to happen. So the first, after we would get a bounce, these little sharp moves to the upside, we would then continue to trade, but the puts would be shorter term. That's right, Slatko, right? They'd be shorter term. So did you notice then all of a sudden we were doing weeklies on the puts, right? We were doing weeklies on the puts and not really hedging much any longer. We really weren't doing, because I mean, more than 50%, 60%, maybe 70% of the move to the downside was over. So we went shorter. There's no reason to go out to April monthlies last week, right? If we know that more than 70% of the move is over, you could see it in the charts, then you just move your puts to shorter term, which is what we did. We went to weekly until things start to shift. And if you wanted to anticipate the next bounce, then you put your long trades, like the calls that we did, you put that on for like next week. Because the bounce could come in 2 or 3 or 4 days, or maybe not till next week. So we started putting long positions on, like in the SPY, for the following week. So the puts went shorter term, and the longer calls we went, still small allocation, went further out. So this is what we've been doing, really. So let's just talk about like what happens and how do we do that. So if we did puts, let's just call it monthly, the longer term, you do that at the beginning of the correction. And that is what we did in the beginning of the correction. We did monthly trades and we hedged with short-term longs in a number, whether it's, you could do the Qs are too expensive. So because buying the Qs are too expensive, SQQQ, which is the inverse of the Qs, you can buy puts on the inverse of the QQQ, and that's cheap. So one of the things that you need to know is when you hedge, it's got to be cheap. And that's why you can use SQQQ puts, which we've done well. You could trade TZA, which is the Russell, right? Cheap short-term trades to hedge these longer-term puts. And as this correction comes to fruition, you want to take your profits as it slows down, as you might have to watch this a few times, as you get oversold or begin to get oversold, that's when you start to take your profits. And we've been doing that, right? The next thing to do is you can either double down, right? If the move is not 50% over, then you double down. In other words, add to the position, roll to next week, right? I took my profits, I'm going another week because there might still be some left, right? There might be some more, to go. So I'll either double down for this week or maybe go next week, some more, a little bit more puts potentially, but I'm going to use the profits from here that when I took profits, I'm going to use the profits to finance a little bit more, only some of the profits. House money, right? Some of it. Smaller allocation. Oops. I meant to do this. Smaller allo. To see if I can get a little bit more out of it, right? But as the bounce becomes more and more possible, how will I know that? Because now we are so oversold, right? On the hourly charts, coming up on the daily charts. You know, we're starting to get oversold. We know a bounce is coming. We watch the VIX and all the other metrics and indicators, right? Once that bounce becomes more evident, we can add hedges if we want. Start adding some hedges. Or you kind of slow down, take your profits, and chill. And then you wait for what? You wait for confirmation. So if you want to I'll just do it real quick here. If you just search the word confirmation or confirm in the alerts, you'll notice that what I've been saying for months before taking trades, before going into the monthly puts, before taking profits, doubling down, before the bounce, you're going to see me use the word confirmation because I'm always looking for that confirmation of the bounce before I start leaning in. So sometimes we just chill and wait for the confirmation. And when we do this, we slowly, as you started to see me do last week, those of you that took the SPY trade, remember the 561, 564 that we sold? That was this Friday. This was slowly start to build your longs, right? But no short-term hedges to the put side. So some might ask me, well, at this point during number 3 here, are you going to hedge? Well, this is actually number 4. Wait for confirmation and then slowly get into your longs. And so then the question I got from some people was, we're putting on these longs, Michael, I get it, but should we put some put hedges on? Answer, no. We don't hedge this now because the market is oversold. There's no reason to think that the markets are going to roll over before the bounce because we're already so oversold. I think you have a better than 50-50 shot once you get the confirmation that we got a bounce, that you could put on a small amount of longs short term without the hedge. Okay? Now, what happens next? Well, we made some money. Did we not see that come to fruition? Did you guys see the bounce come to fruition? So let's look at it real quick. And I'll come right back to that screen. Here's the SPY. Now, if you look at the 561, this was 311. Yeah, and this was done about, let's see, in the afternoon. Yeah. So 10, So just as an example, so this is like Wednesday, Thursday, and Friday we got that lift. Remember how great that Friday was where we took all those, we took off the shorts, made money, took whatever we had long, we made money, and then we gapped down. So I see that we're oversold, right? I've made money on my long-term puts, right? Did we not make money on the long-term put trades in February and in March? Yes. Did we make money on some of these short-term corrective bounce trades? Yes, we made money on those too. But now we're starting to get to a point on the daily charts and on the hourly, of course, that we're starting to really get extremely oversold. So at this point, I give you some levels. If you remember, I gave you the levels, right? And I said, if we break this to the upside, that's the confirmation that I'm looking for to then go into the long side of it, right? So the trade that we took, which was right here, was confirmed by this move to the upside. Now we did get a little bit of selling, but look at the RSI. It stays, it does a little dip, and then up she goes, right? And so this was kind of a double bottom move, but I had conviction that we were so oversold that it was going to trigger, all we needed to see was a move over 560. So we dropped below 555, yes. But as soon as we got back over it again and then held 560, I said we'd see a short squeeze until the end of the day along with a gamma squeeze, and there it is. We got it.
Thanks for watching. Hope you enjoyed this video from Trade With Me Now. Make sure to go ahead and like this video and subscribe to our channel so you make sure that you catch our next video right when it's released. Also, if you have a question or comment, please leave that in the comments section below. And of course, if you want to learn more about Trade With Me Now or join our community of profitable traders, go to tradewithmenow.com. There's also a link in the description below.